Most real estate investors focus on one number and it's costing them tens of thousands, even millions of dollars in missed opportunities. In the next 10 minutes, I'm going to show you the 4 drivers of wealth building in real estate and show you how to use them to make smart investment decisions. My name's Skylar Witt. I'm a real estate investor and owner of Cedar Ridge Management, a long-term property management company in coastal North Carolina. We are a company built by investors for investors, and I'm pumped to share with you my real lessons learned about these 4 wealth builders in real estate since 2011. So the 4 ways that people build wealth in real estate are 1, cash flow, 2, debt paydown, 3, appreciation, and then 4, depreciation. And we're going to break each one of those down one by one. So pillar 1, cash flow. This is the number that everybody looks at, but you shouldn't look at alone. So your cash flow formula is your rental income minus your operating expenses minus your debt service equals your before tax cash flow. Now, all of those things should give you a positive number. If they don't, you have negative cash flow, and I recommend that you sell the property. It's important though to look at this cash flow number in a holistic view, because if you just use cash flow, you might pass up on deals that are actually really good deals for you. I remember passing on a lot of deals because they weren't hitting my cash flow number when I was an early real estate investor, and I really wish I didn't pass on those investments today because of how much they have appreciated, how much appreciation I would have been able to capture, and the debt pay down. So you really want to look at this cash flow number holistically. A trap I see a lot of people fall into, which is one that I did myself, is wanting a huge cash flow number. Now, you need to be conservative in all of your operating expense underwriting, but if your cash flow is positive after doing that, then it might be a really good investment for you. You got to evaluate the other 3 factors. So let's dive in now to the other 3 factors of real estate investing. So pillar 2 is debt paydown. This is paying your mortgage off every single month. And when that loan balance goes down, your equity goes up. So if you borrow, $200,000 to buy a house, and that first year, you're going to have about $3,300 in debt paydown. That is money that's not going straight into your bank account, but it is building your wealth. In year 5, your loan paydown is going to be about $4,000. Now, again, this is money, this is real wealth that you have, but it's not in your bank account. So this shows up on your net worth statement, which is why it's really, really important to look at this number, but it's also really important to keep a personal financial statement so you can see this creation of wealth over time. If you want a free personal financial statement and a video on how to fill one out, check that out in the link in our description below, because the personal financial statement and the habit of filling that out is so key and important to you building wealth over the long term. So the 3rd pillar is appreciation. And this is actually where 80% of your wealth is going to come over time. I've been tracking my returns since 2011, and 80% of my wealth in real estate has come from appreciation. The other 20% has come from cash flow. Now, there are 3 main sources of appreciation. You have monetary policy, you have supply and demand, and you have forced appreciation. And we're going to jump into all 3 of those more specifically right now. So, monetary policy. We have a fiat currency in the United States, and what that means is the US dollar is not tied to anything of real value. So the Federal Reserve can just print money at will, essentially. And every single time they print money to lend to the government, the dollar is devalued. When that dollar is devalued, things of real value, like real estate, go up in price. The really cool thing here is if you lock in a 30-year fixed mortgage, while the dollar continues to lose value, the government is actually helping you pay your home off, because when that home price rises, your loan to value ratio improves and creates wealth for you. The second source of appreciation is supply and demand. you want to invest in an area where demand is greater than supply. This will create appreciation. And if you're watching this and thinking about investing in coastal North Carolina, or you live in coastal North Carolina and you want to feel good about your decision, migration is strong. We have people moving to this area from the Northeast, from the Northwest, from all over the United States. So this is a great market to invest in, to use supply and demand to help create appreciation. Now, a warning here, if you're not investing in this area, you really want to pick your market well, because if you pick a market where the supply is a lot greater than demand, then your home value is going to actually go down. And that would be a bad thing to creating wealth for the long term. All right, the third one that's really fun is forced appreciation. So this is when you buy something and fix it in some fashion, and either increase the value of that specific property, right? So an example is a home, if it was clean, pretty, and nice, would be worth $200,000 in just a simple math example, but you're able to buy it for $50,000. And it needs $100,000 of work. So your all-in costs are $150,000. That mean in the after repair value is $200,000. Well, $200,000 minus $150,000 is $50,000. So you just forced or created $50,000 of wealth. It was just a really, really cool thing, and a great way to build wealth in real estate, especially early on when your focus should be creating equity and creating wealth and reusing your money as much as you can. Pillar number 4 is depreciation. And this is a shadow expense that really helps you keep money today, because the time value of money means money is more valuable to me today than it is in the future. So quick disclaimer though, this is not tax advice. I am not a qualified CPA or tax professional. Consult one of them. This is just simply information that I've learned about over the years and use. So what is depreciation? Depreciation is something that the IRS has built into the tax code that says property devalues, or there's a loss to property over time as it's used. So you can write off that depreciation expense against your income every year. There's 2 main ways to depreciate property. You have straight line depreciation, and then you have cost segregation. In straight line depreciation, you take the building value. So in the example on the slide here, if you bought a property for $250,000 and discovered that the land was worth $50,000, which you can find in the tax records with your county, you then know that your building costs $200,000, and the IRS says residential property will last for 27 and a half years. So you divide that $200,000 by 27 and a half, and that gives you a deduction of $7,273 every year that you can use to offset any rental income, or if you're a real estate professional, offset any of your active income too. Now, the second way, which is the more efficient way of depreciation, is cost segregation. And in cost segregation, you actually break the building components down into their specific parts, and you can depreciate them over their life instead of the total life of the property. And I got an example for you that I want to go in. To do this, actually, you need to get an engineer report. So this is the one I use, kbkg.com. Go there and fill out, you got to buy it. It's about $450 as the time of this recording. And you fill it out. When you fill it out, you're going to get 2 things. You are going to get a report like this. It's a cost segregation report. And as you can see, it's going to break your property down into the different components of your property and how long they last. So in this example, $19,000 can be depreciated over 5 years. $29,000 can be depreciated over 15 years. And then $105,000 is going to be depreciated over 27 and a half years. And then it says in year 1, the total of all of that you can take in year 1 is $52,000. It's a very complex report that you're going to get, and something that you should have on file for every property that you cost segregate. Now, it's also going to give you a Excel sheet of a depreciation schedule. And you can see here, it's breaking this house down into the electrical systems, fire and protection, HVAC, plumbing, other building components, and site improvements. Has a description of the things here. And then over here, it tells you how long the IRS says they're going to last. And it gives you the cost basis of that component for a depreciation schedule. And then your CPA or tax professional is going to use these numbers when doing your taxes at the end of the year to come up with your total depreciation expense that you can take. Now, there's one more inside that's called bonus depreciation. And because of recent tax law changes that have happened and things, there are certain parts of your property that the IRS is calling personal property. And this personal property, you can actually depreciate 100% of it in the first year you place a rental property in service. And it's a huge advantage to depreciate things right now. And you'll see here the depreciation schedule that you get from that website I told you about actually also gives you the bonus depreciation amount that you can take in year one. Before we move on, really, really important here, things actually do wear out, right? So the government's giving you a depreciation expense tax break, but if you just take that money and run and wear your property out, you're gonna have a bad property in 5, 10, 15 years. So it's really, really important that you budget for real capital repairs over time. You wanna make sure you budget for that roof when it needs to get replaced. You wanna make sure you budget for that water heater in 10 years when it gets replaced so you don't get sloppy and so you're not caught off guard about what your real return looks like over time. Because depreciation is a great thing that we can take advantage of, and it's not a direct expense because it's a shadow expense, right? But it is still a very real expense that you need to plan for. If you want to talk more about that and how to use it in your real estate investing strategy, fill out a contact form on our website. I would love to talk to you about building wealth through real estate. All right, so we talked about the 4 pillars of building wealth through real estate. Which one is more important when is important, and your investing stage kind of determines which pillar matters most. So early in your career, you probably want to focus on wealth accumulation through equity, and you're going to focus here on appreciation and debt pay down, but you're going to want to make sure all of your properties are cash flow positive with conservative numbers. And then use depreciation in the background to intentionally keep more of your money in the short term to invest in the long term so you can build wealth faster. You might get to this stage where you have a lot of wealth. Maybe you have 1 million, 2 million, 3 million, 4, $5 million in equity, but you don't have the cash flow that you want. All your properties are cash flowing well, but you're like, man, I just want to retire now. So when your wealth gets to a certain point, then you're going to start thinking about cash flow being more important. And you're going to want to turn the equity that you created through appreciation and debt pay down into cash flow. It's really important to look at all of these things together so you don't pass on any one deal. A great book to read if you're watching this and want to learn more, check out The Small and Mighty Real Estate Investor by Chad Carson. Phenomenal book. Will really, really help you plan this for yourself for the long term. So if you guys want to model your own return for a property, got a link in the show description. You also go to our website. I have a free real estate investment calculator for you. It's a Google Sheet that you can copy on your own and use. I also have a YouTube video about how to use it and what metrics are important when analyzing real estate investments for yourself, right? Like, what should my cash on cash return be? What kind of appreciation should I expect, etc. All of those are answered in that video. I also have a rental analysis calculator on my website and in the show notes. which will give you a real-time, this is what we think your property will rent for with a confidence score. Great tool. And then if you're on the fence and you're like, I don't know if I want to rent my house out or sell it, we also have a rent or sell calculator, which will show you over time which option, renting or selling, would put more money in your pocket. Really appreciated this, guys. Thank you so much for your time. I know it's your most valuable resource. I hope you found this valuable. If you did, please subscribe to this channel, and I'll see you next time.